We've talked about infrastructure funds, a lot of money going into it. Where do you ultimately see the money coming from? Or is it going to be a combination of public, private?
So I guess,
Monies.
in terms of capital wanting to access the asset class, there is absolutely no shortage of it.
Right.
And our
but
surveys,
is it being put to work?
And it is being put to work. But I think that the reality is, when it's put to work, someone has to pay for that capital. And I think that's where the challenge is. Because there's two ways you can pay for capital invested in infrastructure. It's either through user charges or it's through tax that's indirectly funds that infrastructure. And I think that's where it gets complex, because all those require political decision making, and hence why it's so problematic.
So it also brings a question, too, is that a lot of private equity funds have raised their own area for infrastructure funds like KKR, as well as Blackstone. Then you also have low yields again, which is going to really increase the competition for these kind of projects and capital. What are you noticing in terms of the pricing?
So I think what we're seeing, and it's been a trend that's really been substantial for the last 3 or 4 years, is that aggregation or accumulation of capital has led to more competition, particularly at the low risk end of the asset spectrum. So if you've got a mature asset in a developed country, OECD, there's going to be a lot of competition. And so what we're seeing at this point in the cycle is a real premium on discipline, because the challenge isn't that someone there is willing to take a lower cost of capital or return on capital. The challenge is that their underwriting standards are weaker, and so they're actually underwriting to a much lower return than they think they are.
Well, that's interesting. So when you look at infrastructure projects around the globe, Jim, where is it that investors are finding the best return on their investment?
I think where we see the best
risk reward
is where there's a little bit more complexity, where maybe you're dealing with construction risk, maybe there's some operating complexity. But I do think where there's more going on with the asset that requires expertise, I think that's where you're seeing better relative value.
Such as?
So it would mean taking, for example, you take the power sector, which you're just talking about, it would be taking construction risk in a new gas-fired power plant, like we did in Lackawanna Energy Center in Pennsylvania, or taking construction risk in new wind and solar plant.
So to that point, where are you going to take on too much political risk, and where are you going to take on the right kind of risk? In that upgrading the grid or having storage for wind and solar, you can make the argument that that seems like a better risk, versus I talked to Lynn also about the Atlantic Coastline Pipeline that she just can't get built.
So different risks in the mix there. So the risk she's dealing with there is the development risk, and the typical capital we represent doesn't want any exposure to development risk, because there's no control over that risk. It's tied to politics, legal challenges, et cetera, et cetera. And so with very uncertain timeframes, very uncertain costs. So the capital, the institutional capital I tend to represent, won't want any exposure to that. And it falls to strategics like Duke and others to take on that exposure. I do think that where the capital comes in is when the risk is compartmentalized and more certain. So construction risk for the right type of asset is something you can put your hands around. You can have the expertise to manage that risk and exposure and invest and look for that sort of premium of return for taking that risk on.
Jim, what's the interest and actual activity that you're seeing when it comes to the ESG space and infrastructure? Kind of combine them together.
Well, I would say two things. First of all, ESG is an increasing factor in our industry, and there's two elements to it. The first is our clients, particularly the institutions, are responding to their stakeholders. They're responding to the life policy holders, the pensioners, who are demanding action on these factors. When we raised our first global renewable power fund in 11 and 12, if 5% of the institutions had ESG as a factor, it was a lot. 4 years later, if 5% didn't have it as a factor, it was a lot. And today, as we're with our renewable power fund in the market at the moment, I mean, it's even gone further in that there's active looking for that allocation, because the stakeholders, the institutions, are demanding it of the boards and the investment teams, who in turn then are coming looking for that allocation.
Can you find those specific properties, though?
So absolutely.
Because ESG is tough.
It's tough, but it's not so much that there's an asset like a wind farm that is ESG. Any infrastructure asset, any real estate asset you look at, you can apply ESG factors and a filter to assessing both the risk and then implementing it accordingly, whether it's around with infrastructure, sort of community engagement plans, whether it's operating to the highest construction standards, operating standards, applying various policies around governance that again are at the highest standards. So it's a whole range of factors that you look to apply to your assets as you develop them.